Welcome to another episode of Quest for Twice. Today is June 5th. ETRN had a great week. Its stock price rose 60% from about $60 at the end of May 26th to $9.50 today. So that's almost a 60% rise in a week. That's on top of the 20% rise from about $5 to $6 from the beginning of May to the May 26th. So what explains the huge roundup in the stock price? That's because of the Mountain Valley Pipeline was approved via the debt ceiling deal the Congress and the White House reached and signed into law last week. Then the question is, what should I do with my stock? Because of the huge amount of roundup in stock price. For a short-term trader, the answer is simple. Sell the stock, capture the profit. But because I'm a long-term investor, so I'm going to look at the business aspects first, then make that decision. As a reminder, I outlined ETRN's growth opportunities in the past. So in the middle of this slide, it shows the Mountain Valley Pipeline as a growth opportunity. Back then, it needed the West Virginia water permit, but now that issue has been resolved by the Congress. So it will bring online 2 BCF/day capacity with additional 0.5 BCF/d compression opportunity. And also, there is a hammerhead gathering system to feed MVP with Ohio gas, costing $540 million with a 1.6 BCF/day capacity. Additionally, there is a MVP Southgate. That's an extension to the MVP project with a 0.9 BCF/day capacity costing $500,000. So the approval by the Congress basically greenlight the MVP capacity as well as hammerhead gathering system capacity. So what's the impact on the cash flow of ETRN? The table at the top right shows the total MVP and related projects with a capex about $4.08 billion. Annual additional run rate of EBITDA in the amount of $350 million. Keep in mind that $3.5 billion of that $4 billion capex has already been spent. So with the additional expenditure about $500 to $600 million, the additional annual EBITDA will be $315 million. That's less than 1.5 years of a payout in EBITDA. So I can update the cash flow analysis I did previously without MVP. The next year, now the estimated EBITDA will be $1.03 billion plus that $0.32 billion from MVP related additional EBITDA. I assume the next year's deferred revenue will be the same as this year. And the maintenance capex assumed to be $0.3 billion and the interest payment of $0.44 billion. The DCF will be $0.62 billion in this year, then jumped up to $0.94 billion in next year. So if we add the dividend and the capex for this year before MVP, it matches the DCF. So in the past, my conclusion was dividend was safe and free cash flow will be used to reduce debt. However, next year the DCF will jump up significantly, so that will be used to pay for the additional capex to complete the MVP to bring on the additional $315 million of EBITDA. In addition, there will be future capex needs to start the MVP Southgate project. So in the past, my investment thesis was getting a fairly high dividend with the MVP upside thrown in for free. Now the MVP upside has been realized with a huge round up in stock price. So it will be informative now to compare Kinder Morgan against the Energy Transfer against Equitrans. So this table is based on first quarter results and guidances provided by the management. Let's look at the Equitrans numbers. As I mentioned earlier, the EBITDA will jump from 1.4 billion to 1.7 billion in next year. As a result, even with the stock price increase, the EV over EBITDA will be 6.47, slightly less than 6.57 for Energy Transfer, and significantly cheaper than Kinder Morgan. Now let's look at the makeup of enterprise value of debt 6.9 billion versus a market cap of 4.1 billion. Interestingly, 4.1 billion is about 10%, 12% of Kinder Morgan or Energy Transfer's market cap. However, we can see the net debt of 6.9 billion is significantly higher than 10% of Energy Transfer, and is almost equal to 20% of Kinder Morgan's net debt. So Equitrans is significantly more leveraged compared to Energy Transfer, which is higher leveraged than Kinder Morgan. So if we remove the impact of interest payment and sustainable capex, we can look at the DCF, the distributable cash flow. As I mentioned previously, for this year, Equitrans DCF is about 0.62 billion and will jump to 0.94 billion next year. So for this year, the DCF is insufficient to cover both the capex and forward dividend. That's about 1.35. That will have to be covered by the revolving credit. However, for next year, I expect the DCF will be more than enough to cover the capex and forward dividend, given the heavy lifting in the MVP project will done. So if we look at the market cap divided by DCF using next year's DCF, that's about 4.4 for Equitrans compared to 5.5 for Energy Transfer and 7.8 for Kinder Morgan. The difference in the price over DCF between Equitrans and Energy Transfer, 4.4 versus 5.5, can be explained by the different level of leverage, since they have a similar amount of EV over EBITDA. But it is clear that Equitrans is much better value compared to Kinder Morgan from both the price over DCF perspective as well as the EV over EBITDA perspective. So is Equitrans leverage a significant concern? The answer is not anymore. Equitrans debt over EBITDA will be dropping from 4.9 to 4.1 in next year. Its interest over EBITDA as a ratio will be dropping from 31% in this year to 26% in next year. As a benchmark, Kinder Morgan has 23% of its EBITDA going to interest payment. So next year, 26% is still a little high because it's still highly leveraged. However, it's not as stressful as this year or the year before. That's what the approval of MVP project does for Equitrans. And that explains the huge stock price run up. So despite this huge stock price run up, I still think the price over DCF of 4.4 presents a pretty good opportunity and presents a pretty good value. So my decision is to exchange my Kinder Morgan stock to Equitrans stock. and continue to hold the ETRN stock because I believe there is more upside to come. This concludes this episode of Quest for Twice. Until next time, happy investing.